Wednesday, headline is AI killing software. Yep, it's killing software. What up, everyone? Welcome back to the Higher Standard Live. Syed, Rajil, and I are probably going to be recording a podcast tonight as well. So a lot of this, if you like it, we'll get a deeper dive on tonight's show. It'll be out next week, next Tuesday. But that being said, it has been an interesting couple of days. If you've been following the market got a rout yesterday. Cryptocurrency got its ass handed to it, and we're going to get into why, some of the sentiment. We're also going to talk a little bit about what's going on in the market and why we should all probably be cautious. I'm not going to say afraid yet, but I'm going to say cautious. We're going to go over our chart work as per usual. I've fully integrated all the AI and forecasts that we talked about on previous shows, so you will get the full ultra quality experience that we once had. Funny story, a long time ago, we were recording the podcast out of my garage. It was Syed and I. We start off the show by saying the ultra premium, unfiltered truth and all that kind of stuff. And a listener who was a really good, sounding board because she works in social media was like, yeah, I don't know if you can call it high quality. And I thought to myself, man, that's messed up. So we never called it that again. But you know what? Today you're going to get some high quality. Everything's going to be formatted and look super, super sexy. We're going to spend a lot of time covering a lot of data points. So if you guys like the chart work or heavy data, this is going to be an episode for you. I got a lot to condense down in an hour. We're going to tell you everything that happened the last 2 days in about 50 minutes, plus or minus. And we're going to end this sharply at 12 o'clock because Daddy got responsibilities today. We got things we got to get into. So let's, with no further ado, jump into the status of the market. You know this is our starting point. We are seeing a shift into defensive positioning, hiding in safety. Again, using the ETFs as proxies for these indices, the Dow, the S&P, the NASDAQ, the Russell, and the QQQ. You got the markets almost entirely down, although you are seeing some strength in the Dow Industrials. And the reason why ISM manufacturing report came out, and guess what? It came out strong, showing that manufacturing in the U.S. is going to start some growth. The Dow Industrials is heavy in that sector, so you're seeing a little bit better there. And as I say that, of course, it flips to negative. So basically, the day is going down. So again, Our proxy for the markets is always going to be this variant down here telling you green good, red bad. What's the motive today? We're having a bit of a mixed day. We're somewhere in between a mixed day and a defensive position, but effectively the money is hiding right now. The liquidity is pulling out of the market, and people are going, you know what? I'm going to wait and see how all this weird volatility plays out in the markets, particularly around cryptocurrency, particularly around the Fed and some of the things that we're seeing there. Let's jump into some of the sectors because I think you're going to see this reoccurring theme. Again, keep an eye on that bar down. Let's jump into the housing sector. Housing is rate sensitive. You're seeing a lot of this continue to scale up. I don't think anybody's really concerned about the mortgage rates and treasuries. We've seen a little bit of stability since the FOMC in the rate cut conversation. So because of that, not a lot of shift there. Let's pivot over to the banking sector. Credit conditions appear to be the same. Again, the market is still the same as far as the overall risk goes down here for everybody. Credit, CRE, refinancing risk does not seem to be a concern. I think a lot of people during the FOMC conference, the leading up to it, and who knows what's going to happen with Warsh, were freaking out. But today, it looks like commercial real estate and the refinancing risk seems to be getting better, even though there is some interesting stuff in the headlines talking about how a lot of pieces of commercial real estate are now way, way underwater. A really interesting case study, if you look at some of the property in New York, where there's also underlying land leases, that's becoming a very popular topic as of late. So a lot there to break down. Let's get into the mega caps. They're not having a good day today. NVIDIA and this whole open AI investment, not investment of $100 billion has really been driving the price down, and you've seen them take a little bit of a hit as a result of that. Consumer stocks, as you know, are the barometer for consumer health. Those all appear to be positive. Industrials, economy, weak signals here. So the industrial sector is actually a little bit down on the Caterpillar side. I expected this one to perform better, frankly, because this is going to tell you the ISM manufacturers coming back. A lot of these are staples. I also expected GE to do a little bit better than this. So these two were a bit surprising to me. If anybody knows why, I'd like to know. But Union Pacific, 3M, those are all up. Deere all up. I would expect, given the ISM data, that this entire market would be up. I was a little bit surprised to see that. Let's go to the energy sector. Energy all up positive. Exxon, Chevron, Conoco, Schlumberger, EOG Resources all positive. Expected that. Their future is bright as long as AI's future is bright. But there is a play here to be made. If you see AI start to have some impacts like we're seeing right now, and there's a bit of a narrative change now, a lot of people freaking out, particularly the software piece. You're going to see that continue to scale these guys down because if people have less AI implications or more AI implications, that could increase or decrease the valuation of what they're expected to do from a profits perspective. And of course, capital preservation is on. Why? Because we're in this position right here. We're in a defensive mixed day. People are going in stock. If they're going to invest today into stuff like this, they're going to try to be very thoughtful and pragmatic about where they put their money. Let's go in to the Fed's liquidity position. And this happened the last time too. I don't understand why that happens, but let's go back here. Liquidity Pulse Index right here. We're at a 17. We're currently draining cash out of the system. Fed balance sheet is moderately healthy. Fed repo line continues to be borrowed on. Treasury account net liquidity level is still a 4 score, meaning that you get a liquidity pulse index at 17. So we're in a bit of a restrictive and draining position. Once the economy gets flush with cash, you tend to boost growth, not decrease growth. And that's why we're seeing a bit of a defensive position. Let's go into the synthetic volatility index. This is our proxy for the VIX, our fear gauge, if you will, 81. A reminder from shows past, we started off at 90. We saw this drop down to 85. We are now down to 81. To me, that signals a pretty healthy ongoing trend of slightly increasing volatility and fear in the markets. We're still well above normal in a calm state, but certainly something to keep your eye on as this particular icon here, calm 81, tends to flip. You're going to see some scary stuff come in the back of the market, but we are starting to see fear incrementally creep back in. The home market continues to be strained. Keep an eye on this. We're going to talk about this today. Supply constraint is a misnomer. I don't think there is supply constraint. Clearly, the data suggests otherwise, but we're going to talk about what the rhetoric is that you've heard about housing and affordability versus what the actual facts are. My housing pundits, pull your panties up. You're going to be upset today. All right, let's go to the calendar real quick before we jump into the rest of the market. This is your ISM servicing PMI, which came out today. It came out positive. JOLTS report also came out today. I have not seen the data on that, and I probably should have, considering it came out at 7 a.m. Non-farm payrolls comes out on Friday, and the rest of the week has got pretty much Michigan consumer sentiment. Everything else will be pushed into next week. So not a lot of volatility coming our way in the not too distant future. Let's go to X. This is our XAI. These are the topics that are trending most on X right now. For a reminder, what happens here, X pulls all this information in. It's going to analyze it. It's going to come up with, number one, the headline that we're here seeing, and then their X interpretation of it using AI. And it's going to give you some idea of where and how this could impact things. So let's use this as a great starting point. Number one, it's got a 5% bearish impact. Actually, this is up to 17% since I brought it up to now. Let me refresh this one more time to see if we got any change here. Yep, 17%. Okay. AMD plummeted today 17% after providing weaker than expected earnings guidance, wiping out $65 billion in market cap. Ouch. That's not good. In what could be the worst day since 2018. That's a rough day. Yeah, not so good. It's going to have impact for the semiconductor space. AI's insight here. Massive sell-off creates potential oversold bounce opportunity if guidance was overly conservative, but sector contagion risk remains high. The overall contested controversy score is about 3. I don't think you trade on this, but if you wanted to see if the analytics without the human impact suggested that you should trade on it, well, we can do that. We go right over to our forecast model. What up, Sean? How you doing, brother? Let's go over to the forecast model real quick. Let me see here. Got AMD up. Let's pull this up real quick. Here's your forecast model for AMD. It is currently trending on X, hence the reason you see the trending icon there. It is down big. Trade allowed. It is saying do not trade this. Hold cash. And if you are going to trade it, you can trade intraday to day only, but the risk here is very much elevated. So the analytics in the AI model are telling you this is not headline risk that you trade. This is headline risk that you watch and go, thank God I'm not invested in it. All this while the market is actually relatively healthy from a macro perspective. So interesting perspective here. AMD momentum, selling pressure, liquidity pulse, synthetic volatility, calm conditions seem to be the market impact, which is making everybody feel comfortable, but everything else here seems to be very negative. So do not trade that one, kids. Let's go back to XAI. And we're going to go back into our traditional our traditional social media look here shortly. I prefer that, but this gives us kind of a large amount of information to work with really shortly. Of course, you've been watching the news. We're going to talk a lot about this today. This is going to make Saeed happy wherever his little heart is. Bitcoin crypto collapse. Bitcoin fell below 73,000 to 75,000 key support levels, while ETH, Ethereum, dropped below $2,100, with crypto now down significantly year to date amid broad selling pressures. We're going to look at some of the reasons why that might be happening. The breaking April 2025 lows suggest deeper correction ahead, but extreme fear often precedes meaningful bounce in crypto markets, which is a strange paradigm. To me, you could see some upward mobility on this again, but I think you watch this one before you decide what you're going to do. Tech sector sell-off, yeah, that's happening. Broad technology stocks are experiencing sharp declines, with semiconductors leading losses as the NASDAQ tumbles and VIX spikes. VIX is the fear gauge, by the way. 15% amongst mounting sector pressures. Yikes, that's not good. That's a toughie. Pretty significant problem here. So, indiscriminate tech selling creates quality stock opportunities, but wait for the VIX stabilization before deploying capital aggressively. Okay, well, let's see what that looks like, because I don't check the VIX. I check our synthetic volatility index. But you know what? I've got a bias. I know that. So let's. Oh yeah, there you go. Okay, so let's go to the full screen here. Bam. VIX is at 19.97. I generally tell people if below 20, you're okay. Anything above 20, and we're very dangerously close to that, you should be somewhat concerned. I would say a 2-point move in the VIX in a single day does signal a healthy degree of fear. Again, this is not wildly scary. This would be your scary time here. This is why the synthetic volatility index puts us in that kind of calm, normal state. But definitely something to keep your eye on as you see the markets pivot and change. Let's go back over to XAI here. So the tech sell-off in the sector may or may not be something that's a little bit longer term. We will see. All things in due time, as I say. All right, U.S.-Iran nuclear talks collapse. Nuclear talks between the U.S. and Iran scheduled for Friday were reportedly canceled, causing prices in oil to surge between 3% to $65 a barrel on geopolitical tensions. I expect this conversation to continue to happen. And using this for nuclear talks is wild and frankly uncalled for. I don't think you can use the regime constraint over a populace of people to negotiate nuclear positioning and better your stance geopolitically. That just seems in bad taste to me. But whatever. That's just something I have no control over. MicroStrategy, Bitcoin losses, precious metal reversals. You saw this big in the news yesterday. Silver and gold prices posted massive reversals, with silver falling $9 an ounce and gold dropping $220 an ounce in under 3 hours, while Chinese gold ETFs saw record outflow. So cryptocurrency adjustment, gold adjustment. Remember we were talking on previous shows, you got the market all-time highs, real estate at all-time highs. Now this, gold and precious metals at all-time highs. Well, that seems to be at least mildly correcting. And of course, my guys over at Robinhood, shout out to Vlad. Robinhood stock hit its second most oversold level in history among the broader market sell-off, down nearly 10%. Extremely oversold readings historically mark good entry points for Hood. I think this is a good buy opportunity for them, but you know what? Let's not take my word for it. I think for them, they're very much tied to cryptocurrency as far as their overall market sentiment. Let's take a look at the outcome forecast model for them. This is Robinhood Markets. It is trending, as you saw there, on X. It does not suggest trading right now, suggests cash, hold intraday elevated. I think this actually might be a buying opportunity for some people, but it really depends on where you think crypto is going. This is basically telling you that because the market conditions are calm, everything else seems to be moving against it, i.e. liquidity pulse in the Fed and the synthetic volatility. But I don't think I agree with this one. I think that's where the human comes in, and maybe I'm biased. I like the team over there. Let's go to the stock chart. There we go. All right, so we are trading at or near intraday low, so this could continue to drop down. Now I feel like Kramer. Damn it. But yeah, so you're seeing an intraday. It's not terrible, but let's go to the 3-month look here. Let's see what we get. There we go. All right. Yeah, 3 months, not so good either. Let's check out 1 year. Year to date to me is a little bit too presumptive, so let's not go there. So over the 1 year, last 1 year, they've moved pretty well. They're low somewhere down here. That's a pretty wide gap in pricing when you see this up here. So interesting to see how that's pivoted. So up 50% over year over year, and meanwhile, over the course of the last 5 days, we've seen them adjust. Let's see here. Okay, 23%. Wow, that's an ugly 5 days, huh? Tied to cryptocurrency. So I guess I should not be too surprised by that. But hoping for the boys, lots of positive, wishful thinking for them. Let's go to the comments. Who's out there? Who's joining me today? Let's see. I got the Instagram. I'll go to you guys first. I can't pull your comments up there. Hello, everyone. All right, let's go over to the multiple social platforms and see who we got on here. I think, Sean, I saw you out there. I saw some other people on some different platforms as well. Where are you at? Hey, there you go, Sean. What's up? Could be a good pick up for another round 65. Yeah, it could be. You're talking about Robinhood, I'm assuming. The administration usually waits till Friday after the closing of markets to do anything. Yeah, I agree. That's AMD, not AMC. Yeah, AMC is not somebody I've looked at anytime recently. They were part of that meme stock currency lift up there. I expected that to be a continual conversation. I was reading a story yesterday on a guy, like a 55-year-old factory worker who was going home at night, like really upset with what he wanted to do. He was looking for a second job. We're going to talk a little bit about second jobs here in a little bit. And he was trying to figure out, like, what he should do with his life. And he started reading about, like, meme stocks and everything else, and bought GameStop at just the right time, made like $1 million, pulled his cash out, quit his job, and just never worked again, and stopped investing. And it was an interesting story. It's wild. Luck, they say, is a combination of preparation and opportunity, right? And I guess that guy was just in the right spot to do all of that. All right, let's get into the headline stuff that we've seen here. We are going to play some videos today. For those of you who like it, whenever we do that, we're going to do it. Let's talk a little bit about Anthropic and some of the AI news that we're seeing impact the market today. I'm going to go to the widescreen format because Instagram doesn't like my social formats anymore. A new AI automation tool from Anthropic sparked a $285 billion rout in stocks across the software, financial services, and asset management sector on Tuesday as investors raced to dump shares with even the slightest exposure. And, anytime I hear race to dump shares, okay, and then I see things like AI in combination with that, I'm seeing precious metals change, I'm seeing all this stuff happen, I get a little, a little concerned. And I think the market is showing us that today. When you go and you look at things like, for example, the status of the markets here, you're starting to see a pretty interesting correction in this particular space here. That's your QQQ, the top 100 performing stocks in the NASDAQ, which are usually tech heavy. So yeah, I think that's going to be problematic. The Russell and the NASDAQ in particular is also down. Top 100 appear to be lagging and pulling, or tend to be leading and pulling down the rest of the NASDAQ and the financial tech sector. So I think this stuff is hitting the world pretty hard. I think it's probably a real interpretation there. Let's go into my next article. I'm setting the tone here. So this is for Saeed. Okay, Saeed, I get it, brother. You don't like Bitcoin. I get it. I'm not here to judge you. I'm just here to tell the world. All right, this from, oh, well, that's a big banner. Forbes, shame on you. There we go. All right, let's pull this bad boy up for everybody to share here. Bitcoin prices fall below 75,000 to reach a fresh 2026 low. That's not so good. Bitcoin price dropped less than 75,000 on Sunday, February 1st, reaching their lowest point since April 2025 as multiple variables combined to fuel those losses. The world's most well-known cryptocurrency fell roughly $74,000 to $74,500 according to Coinbase data from TradingView. At this point, it was down more than 40% from its all-time high of over 126,000. Additional Coinbase figures from TradingView reveal. When asked what cause contributed to this latest downward movement, analysts cited a wide range of factors. Of course, I'm going to read one of them to you. Bitcoin's drop was macro-driven, said analyst Joe DePasquale, specifying that a, quote, broad risk of backdrop hit beta assets and BTC can still trade like a leverage proxy for liquidity conditions. To me, you know what that sounds like? That sounds like a dude who's going like, shit, I backed this. I should probably say something that defends it a little bit because this is weird. And it is weird. I think that the entire market has been a little weird, but you don't take my opinion for that. There are people out there who are smarter than me, who sound a lot like Saeed and are a little bit negative. I am not one of these people. I think that cryptocurrency will be fine. There's just too much money in it. It's too far backed, but there are the wet paper towel hands crew, and well, there's a leader of the group, and his name is Michael Burry. Michael Burry says Bitcoin's fall in price could trigger a death spiral. That's not ominous, Michael. Real dark there, huh, Chief? Yeah. Okay, well, let's read about it, shall we? Bitcoin has been exposed as a purely speculative asset. Sounds a whole lot like Charlie Munger, may he rest in peace, and Warren Buffett, and is not near the debasement trade hedge that gold and other precious metals are. Well, I would point out that gold and precious metals are also seeing a bit of a correction today, brother. So is it really a hedge? Are any of them really a hedge? No, the only real true hedge against inflation is to keep investing. So for us to sit here and naively say, oh, crypto isn't a hedge, that's a little disingenuous. Now, is it a purely speculative asset? That's a conversation to TBD, TBD. At $50,000, miners would go bankrupt and would be forced to sell their BTC reserves. Bitcoin, tokenized metals futures would collapse into a black hole with no buyer. Michael Burry from his Substack blog. Sounds dark. Sounds grim there. Not sure I want to hang out there. Also, not a good picture of him. Death spiral. Oh, I love it when they define really, really, really harsh adjectives. A situation that keeps getting worse, and that is likely to end badly. With great harm or damage being caused. Burry states that if Bitcoin falls another 10% under 70,000, MSTR will be over $4 billion in the red. Yeah, it's probably accurate. So, and we are not far from that today. Bitcoin is down over 25% over the course of the last year, erasing its post-election gains. And I don't want to be the guy who does this. I look like Saeed whenever I do, but I'm going to do it. I'm going to go over here to CNBC. I'm going to tap into the crypto. I'm going to look at Bitcoin. He said 70,000. Well, kids, you're at 73, 124.15 as of right now. And for those of you who need a reminder, this show is recorded live. That is 11:25 a.m. PST on February 4th. Also, 10 days before Valentine's Day. I love you guys. So yeah, it's a real problem, and that's a real thing. This could change the market landscape. We always thought that AI was going to be the first thing to kind of go nuts because it was all so overhyped, and we saw this ETF adoption of cryptocurrency, and cryptocurrency plays into the AI space, but maybe it's cryptocurrency that sees the correction. So, it remains to be seen, if you will. I'm going to check the comments. Oh, there it is, kids. There it is. Well, let's. Hey there, Saeed. This show, even though you're not here, this one's for you. So whenever you give me the wet paper towel hands, just know I love you. Your soft, delicate wet paper towel hands. Yeah. Yeah. Okay, so let's keep going. There's a lot here to unpack, and I think that there's a lot that I think people will find interesting. This isn't just the AI world that's getting impacted here, unfortunately, or fortunately, depending on how you look at it. There are other markets that are taking hits, and the job market, labor market is one of them. So if you're looking at the job market, labor market, and you're thinking to yourself like, oh, this feels weird, there is this rhetoric that continues to pop up from the FOMC that they haven't seen the impacts of AI in the job market. You know what? I call shenanigans. All right, we have seen it. Oracle is reportedly considering cutting back up to 30,000 jobs at U.S. banks as U.S. banks pull back from its financing its AI-driven data center projects, creating one of the largest potential layoffs in the technology sector in recent years. Not AI direct, but certainly AI adjacent, and does give you some kind of market sentiment here. So yeah, there are layoffs. They are AI adjacent, and yes, they are happening. This on the heels of Amazon and some other people. I was going to put up a list today of all the people who laid off, but God, that is a little depressing right now. And you know what? I got other ways to depress you. So I'm going to pull up different charts. This one from Ed Elson. I saw this last night and I went through it a couple times. I reference these dudes because I find the data and the charts. If the charts look good, I'll use it. But at the same time, grain of salt. I don't know who this guy is. So whatever. AI is gutting parts of the labor market, and our grand strategy is do nothing. That doesn't exist. Matter of fact, if you were the FOMC, I think your head would be technically buried in the sand right now because you're not even acknowledging this is real. You're saying, well, we're trusting reliable resources to let us know, and what we've seen so far is we haven't seen. It's all a lagging indicator, brother. We all read the same headlines, and the headlines are people getting laid off, and this is a great example of that, right? So, more than 1.2 million job cuts were announced last year. That's the highest number since the pandemic. And for those of you looking on the screens there, that's the pandemic. That's the current job market. You can see, if anything, when you got a trend that looks like this, if you're starting post-pandemic, and certainly even if you remove the pandemic and you compared it to those 2 years back there, 2007 to 2009, this period of time here is the great financial crisis. This period of here is the pandemic. And this is us today. And this is not like a spike up like overnight. This has been a slow, casual growth. Remember, unemployment went from 4.2, 4.3, 4.4. And I know the way they calculated unemployment is also questionable in and of itself. So we think the real unemployment number is very different. That being said, this is undeniable, okay? Look, great financial crisis, that's where it's at. Jobs are in jeopardy. I don't care what anybody tells you. I don't care how they spin it. Jobs are in jeopardy. Efficiency is changing. The landscape is different. And frankly, in my mind, despite the number, the trend is recessionary. Economists who are watching this, who are going to like poop themselves or send me messages talking about how I don't understand finance, you're welcome. #blessed. All right. Let's assume we're witnessing the arrival of the greatest labor market disruption of the 21st century. What do we do? What do we do? I read this at 4 o'clock in the morning, by the way, so this is the kind of nerdy reading that I do. Lawmakers assemble a task force. A task force established, a czar is hired, and finally the grand strategy revealed, do nothing. It's not real. You're imagining it. It's not real. It's no coincidence that the rest of the world is both dramatically more excited and less nervous about AR than we are. Share of population excited about AI, U.S. is very, very low. China, very, very high, ironically. Kind of an interesting thought process. Saeed, are you creeping in on the Instagram chat as well as the YouTube chat? Because I think that kind of makes you a stalker, brother. But yeah. Okay, let's go over here. This is all from Professor G Media. Oh, that's interesting. So the solution to our AI problem isn't to do nothing. Public laws signed by Congress are going down. We might once have had an AI China policy, but it no longer exists. So a lot of evidence that I have nothing to term for this other than libertarian mind virus. Okay, that's a little politically extreme. Let's just say everybody's pockets are lined with money right now, and corporations are making more money than ever before. I don't want to read more, Ed. You got a little dark there at the end, Chiefy. I don't like that. But what I will say, in Ed's defense, corporations are making more now than ever before. 16% profits, but they're returning less in dividends than they have in a long time. Not the lowest, but less, because they need the money to redeploy back into capital expenditures to further increase their efficiency. But this merry-go-round does, in fact, come to an end. And when it does come to an end, it impacts the American dollars in the wallet in a real painful financial way. But of course, there are people who are smarter than me who talk on these things quite regularly. And when they do, they say stuff that I think should be noteworthy. For example, we're going to look at Anthropic's. I wonder if this will show up the right way, actually. I've been having this problem as of late whenever I do this thing on social platforms. That kind of works. Yeah, that worked here a little bit. Let's play this a little bit and see how this goes. This is Anthropic CEO Dario. AI could replace 50% of entry-level white-collar jobs. So is it paranoid or is it not? Let's see here. And I'm going to refresh this because I don't think it's going to play the right way if I don't.
Employment to 10 to 20% in the next 1 to 5 years.
Yes,
that's shocking.
That is the future we could see if we don't become aware of this problem now.
Half of all entry-level white-collar jobs.
Well, if we look at entry-level consultants, lawyers, financial professionals, many of kind of the white-collar service industries, a lot of what they do, AI models are already quite good at, and without intervention. It's hard to imagine that there won't be some significant job impact there, and my worry is that it'll be broad and it'll be faster than what we've seen with previous technology.
You've said.
Okay, so yeah, broad and faster than we've seen with previous technology. Okay, that's scary. So basically, this whole fear of how this impacts the job market being ignored is kind of wild when you think about it in the context of here you have, Dario, CEO of Anthropic, saying that he thinks it's going to impact people faster. And he's talking about entry-level jobs. But what does he say? He's talking about entry-level jobs across all professional sectors. He's talking about entry-level lawyers, entry-level financial analysts. Okay, there's two parts of this problem that are pretty obvious. Number one, how do you get experience if you can't do the job at an entry-level position anymore? Because if you're not doing that job at entry-level position, and now you have this rapidly changing, fast dynamic AI technology, and I do believe, and I do agree with him, this is going to shift things much faster than a cadence we've seen historically. But if you can't get into an entry-level position, right, how are you going to learn to do the job? And if you can't learn to do the job and technology is changing at this rapid clip, humans are effectively working themselves out of those next level up jobs because this is getting the experience and not you. So these are reasoning models. They are supposed to get smarter over time. And if Moltbot has taught us nothing, it's that AI can and will do things that we haven't taught it. And there was actually an article that came out not too long ago, and I haven't referenced it on the show yet, that Google has acknowledged that their AI is doing things they have not instructed it to do. So again, it's a reasoning model. It's a learning model. It's supposed to happen, but over time, we're going to reach this inflection point, and it's probably going to happen later this year at the earliest, maybe mid next year at the latest, where you get to true AGI and humans become kind of an obsolete mechanism. And I don't mean that in like this, doom and gloom Terminator sense, but I do believe that this will have a very transformative effect on the market, and I think this is going to impact humans in our lives. And we should not ignore that. Another person who's valuable in this conversation is the CEO of a little company called Microsoft. And well, he's going to make some comments here that I think are worthwhile to share. I'm going to go over to the social window here. I'm going to refresh this bad boy. And let's see if it plays. Come on, be a good boy. There we go. All right, there we go.
In knowledge work. For example, I'll give you LinkedIn. We used to have product managers, we had designers, we had front-end engineers, and then we had back-end engineers. And so what we did is we sort of took those first 4 roles and combined them and said, they're all full-stack builders. This is probably the biggest.
So, and that goes to show you right there. So there were separate builders, historically speaking, in the space, and you're already seeing the rise of those people being taken out. You don't need somebody to do all these things. Matter of fact, I was watching the news earlier today. I was watching CNBC, and for those of you who don't know, the office has TVs everywhere in here. And I was watching the news, and literally an analyst, or not, and one of the I think desk hosts for CNBC, I can't remember who it was, said that she recreated Monday.com's website in an hour by herself, playing with AI as part of her kind of diving in for reporting purposes on AI and want to be familiar with it, and that she has no coding and development experience. So now you got Anthropic CEO, Microsoft CEO, all saying that the job market is going to be changed in a meaningful, measurable way in a very quick fashion, and that it is going to be different than we've seen, like with adoption of other technologies. It's going to rise super quickly. As somebody who uses AI a lot, I think this is going to displace jobs, and I can tell you that I think it's going to displace a lot more than just entry-level positions. I think that's just wishful thinking, and that's just the beginning. So let's dive into some more fun facts, because I know you guys are already depressed. Scott Bissett. I don't know why this is him making these comments and doing this, but for some reason, and reason unknown to me, Bissett was asked about the use of AI in financial services. And we saw right at the top of this that we think that financial services are going to be impacted a lot, but we also saw Oracle talk about the layoffs as it relates to that. But let me pull this up, and you guys can tell me what you think. I think this is an interesting shift here in narrative. So let me
issue of explainability. Any concern about that in the use of AI in the financial services industry?
I'm sorry, what was the question?
The issue of explainability, how when people apply for credit and are denied, we don't have the ability for AI to explain why they were denied. Is that a concern? I mean, we are talking about the trust within the financial services industry.
It could be a concern, but we don't view it as a priority for financial stability.
That's the truth. That's the truth. On the issue of
So, number one, that is so wildly disconnected. I have personally been in the room and talked to another number of people in the banking sector who are selling and using technology today, i.e. Wells Fargo, that can explain to you. So anytime you are denied anything for credit purposes, and this is just goes to show you how government is very disconnected to the reality of what's actually happening. You have to send out, anytime you're denied for credit, you have to send out an adverse action letter if it is for consumer credit, right? And it's just by law, these are things you have to do. These adverse action letters are not super technical. They're basically a form, and you check a box saying the reason why you were denied. If AI can make an algorithmic and possibly logical reasoned decision to deny credit, then it can simply check the box in the form and mail the form out on its own. Frankly, Moltbot, i.e. Claude, being used as a personal AI agent, can and does do that now, today. So for these guys to sit there and go like, I'm concerned about the financial security and ecosystem, that train left a long time ago, okay? That has already left the station. And yes, credit decisions are in fact being made by AI. Now, the regulatory zeitgeist is not there yet and how they're going to handle it, because the biggest challenge they're having is how do you guarantee security of data if you have a contained AI and it's able to do things outside of its ecosystem? How does that data protect it, right? And using Moltbot as a great example of some of the security risks that we've seen as of late, you've seen Moltbot go to websites. People have put stuff on websites they want Moltbot to get a hold of so they can then infiltrate the system. So the question is can you have an AI ecosystem that runs well with access to the world, but then trust it from a security perspective and people not getting into it? You've already saw all of Moltbot's information. I think it was like 165 million users and their API keys. Maybe it was just API key. They all got tapped and were all distributed not too long ago, a couple days ago. So it's a pretty palpable thing. But again, the world is shifting. Okay, this is a financial show, so I understand you guys talked a lot about AI, and you're like, "What the hell, Chris?" Well, let's talk about something a little bit more, I guess, up our usual alley. This from the Washington Post, a little periodical that people know about every once in a while. Boom. Why nobody really knows the scale of the U.S. housing crisis. If you're going to read any article I provided today, this is probably a good one, because there's some really interesting tidbits here that I think really show that there are some key things that we've been led to believe that may in fact not actually be true. The most, I guess, obvious of those things is that we have a shortage of housing supply. I don't think so. As a matter of fact, I mean, again, my data, my systems here, but this is our home affordability index. And again, when this first came up, I was like, what the actual shit's going on here? But yeah, you do have supply and you have a relatively healthy amount of it. I'm not saying that it's perfect, but certainly have a healthy amount of it. The biggest problem is house pricing and interest rates, okay? The supply is not in and of itself the problem. Now, there are some always arguments to be made about whether the supply is in the right spectrum, new home owners side, affordable housing versus, unaffordable luxury housing. I get all those arguments, but generally speaking, we got enough supply. Experts say the U.S. needs an additional 2 million to 20 million homes to fix the shortfall, underscoring the challenge of meeting the nation's housing needs. Experts. Let's go slowly to the experts, shall we? Let's take a walk down sexy expert lane. All right. Over at Goldman Sachs, analysts put the number at 3 million. Zillow's estimate tops 4 million, while Bookings projects 5 million, and McKinsey says 8 million. Meanwhile, congressional Republicans insist the shortfall is closer to 20 million. I'm just gonna give you a general piece of life advice here from a finance perspective. Anytime you see estimates ranging from 3 million to 20 million, okay, that wide of a delta, no one has any fucking clue what they're talking about. Okay. That's the baseline. There are the economists who contend there's no shortage at all. Oh, really? The disparate projections reflect the challenge of quantifying the nation's housing needs, a puzzle that rests on assumptions about how much a home should cost, how many people it should hold, and how big a footprint it should have. I don't think any of those things are hyper relevant to the conversation. The fact of the matter is they are unaffordable no matter which of those elements you tap into. So that you can't deny that. Vacancy rates in missing home households. The U.S. has 146 million homes. Census Bureau data shows of those 8.1 million are doubled up households, meaning people are sharing space with non-relatives. Zillow's housing estimate assumes most of those people would prefer to have their own place. Obviously, my guy. I mean, Jesus. Zillow's housing estimate assumes most of those people would prefer to have their own place. Zillow, really? I read it twice. Okay, because it's just a shocking piece of information there, Zillow. There are also 3.4 million vacant homes available to rent or buy, the real estate website says. So Zillow economists subtracted the number of available homes from the number of doubled up households and concluded that the nation needs 4.7 million homes. Again, no one has a universal way of looking at this, hence the wide disparity in what people think the normalized amount should be. Vacancy rates have tumbled after the early 2000 housing boom ended, meaning that there's not a lot of vacant units. The suggestion is that there are homeowner vacancy versus rental vacancy. What I'll point out here is just so I can say that I said it. Homeowner vacancy is about 1%, meaning the homes for sale on the market, versus rental property vacancy is about 7%. Rental properties, 7% vacancy. Having a healthy degree of vacancy in my mind is always symbolic of healthy transitory migration, if you will, from property to property over time. I think one of the challenges you're going to get is people aren't going to be willing to sell, and we'll talk about the rate side of that in a little bit here. But long story short, there's a lot of different opinions here, and I'm not going to read the whole article. You should read it yourself. There's some very interesting tidbits, but they talk about spending, they talk about a lot of things, but we're going to focus in on this article, this part of the article here, and if you can't read this, it's okay. There may be no shortage at all. Urban planning professors Kirk McClure and Alex Schwartz examined 900 U.S. metropolitan areas and found that only 19 had added more population than housing since 2000. That's an interesting note, and it should get the mind going here, right? If the population isn't growing faster than the housing supply, then you've got a velocity issue. That doesn't mean you don't have a housing shortage issue, but you certainly have a velocity issue. Before the 2008 recession, they argued developers built far too many houses, leaving room for underbuilding in the same years since. And I think that's accurate, because what happened is these builders got their ass handed to them during the great financial crisis because they had all this property sitting there. They couldn't get people buying it. They had all this capital that was tied up in property. They had to drop the values, and they lost a lot of money, and their stock prices all took a hit, so they don't want to do that again. Yes, we have a shortage of units in the low-income price points, but not overall, McClure said. He contends it would be far less costly for the government to help poor households rent or buy existing units than to build new ones. As a matter of fact, we're the first time in history where buying a new home is cheaper than buying an existing home. Let that sink in. There's location and all that other stuff, but generally speaking, that's not been the case historically. Newer usually means more expensive, but not in the housing market today. The best housing programs right now would be an increase in the minimum wage. Yes, it would be. The best housing program right now would be an increase in the minimum wage. You get people up to $20 an hour and suddenly life gets better. We can't build our way out of this problem. I wholeheartedly agree with that. And there really are only 4 levers here. And I'm going to spend some time before I get back to this article, and I do want to finish it, There's only three levels, right? Okay. You got your little house here. House prices can come down, right? You got interest rates. They can come down. And then, of course, you've got wages. That can go up. Those are your levels. Those are your levers. Now, in a perfect world, one of those would solve the problem in and of itself. In order to get homes affordable, you'd have to be around, call it the 2.5% rate mark, okay? That's where you'd need to be a quote affordable home again. Historically speaking, the average interest rate over time is somewhere between the high 7s and low 8%. So 7 to 8% is your normalized healthy economic rate. Now, we lived through an environment of 14, 15, 16 years of artificial interest rate deflation, and because of that, people think that this is high when historically, according to perspective, it is not high. I don't think we're going to get from today's market where, let's just call it 6% where we're at, down to 2.5%. Even if we lower rates down to near zero again, that is just going to ignite the housing market and drive values up near term. It doesn't solve the problem. Housing, on the other hand, would have to come down somewhere in the neighborhood of 35 to 40% to become more affordable, right? And I don't see that happening either. Why would it? There's not enough transactional volume because there's a lot of people sitting on properties they're not going to sell for a long period of time. Housing vacancies at 1%. We just saw that. I'm trying to dodge in between all the text here. Now, of course, the question is well, how much do wages need to go up? 58%. 58% for housing to be affordable. If none of this other stuff changed, that's where you'd be at. So again, house prices can come down. Interest rates can come down, or wages can go up. In an ideal world, all three of those things would happen. But when you go over to something like the housing affordability situation here, you can tell the easiest one to move the needle is, of course, interest rate pressure, which is why you see the National Association of Realtors, you see mortgage loan officers. They always talk about the solution to the affordability crisis is to lower rates. Unfortunately, doing that for too long, too low, led to the other problems that we have. So doing this again will just further exasperate those problems. So that really only leaves two logical conclusions to solve this problem. And that's house prices coming down and wages going up. Those are the only two things you can really move, because this is not going to see a whole lot of improvement relative to historical interest rate prices. And you're seeing that already with the Treasuries somewhat divergent from that. So these are your only ways of fixing this. And I got bad news for everybody. Unless there is a catalyst, and maybe Bitcoin and cryptocurrency and what's happening in the markets right now is the catalyst, but it hasn't yet, remains to be seen. But unless there is a meaningful catalyst in the market, this resetting of the housing market and wages probably won't get there, because guess what? AI rolling out, like we talked about the top of the show to start this. That's what we started there. If there's less of a need for humans in the market, less wages are going to go to humans. And this, I stay up late at night. Sometimes I scratch my head. This is part of what you see Elon Musk talking about, where he says, robots are going to come in. They're going to be AI, infrastructure, and all these things are going to change. And you shouldn't worry about saving money, because in a couple of years from now, it won't even matter. Maybe. But I can tell you, as of right now, I don't see a pathway for more people to make more money or be more valued by corporations if they're making the highest amount of money they've ever made before at 16%. And those returns to you, me, the consumer, are not quite what they are. And we're seeing unbelievable inflation. And it costs 58% just to get homes more affordable, and wage increase. We have a problem that's going to take a long time to fix. Let's go back to the article. I want to touch on a couple more points here. This view of the current housing market transcends partisan lines, with some of the highest and lowest estimates of the shorting coming from the right. So again, I don't like the partisan lines when it comes to what should be a data-driven argument, and the debate is always how you look at the data and how you manipulate it to reach your political conclusion. It really shouldn't be that. We're talking about people's homes, their livelihood, life, liberty, pursuit of happiness meant home ownership, right? Economists at the Libertarian Cato Institute contend that housing production has kept up with population growth. Just because people want to live in big houses in expensive, densely populated areas, they assert, doesn't mean there's a shortage. I agree with that statement. It might be harsh, but I live in a two-bedroom, 2.5 bath, 3-story attached townhome. So my own granted, I would live a lot larger house. Anyway, a shortage is literally people don't have anywhere to live. That's not what we have. And I think there's a social media component to that, right? We've all got this false expectation of what normal is because we see things on social media, which is certainly changing our perspective. In the end, the dispute doesn't just come down to the choice of mathematical models, but varying interpretations of what a housing shortage even means. Quoting here, if I have a hard time finding an apartment in the area of Washington, D.C. that I like, I can still move to Maryland and find something, Michael said. The idea that I'm just completely shut out of all of my options and I can't find any place to live, that's what a shortage evokes. And the data doesn't support that. Erdman views it differently. There are 28-year-olds living with their parents that wouldn't be there if there were a house. If that's not a shortage, I don't know where you could use the word. I think they're confused. That 28-year-old lives with his parents in the house, not because there's a housing shortage. That 28-year-old is likely saving or wants to buy a home one day. And the cost of rent and the cost of the mortgage, plus the down payment and all the other financial accoutrements that go with it, are too expensive. So the cost of living is too high. Not that there's a shortage. If that person was making enough, they could go rent and buy a property. So that's not a housing shortage. That's a pricing shortage. And that's the rhetoric spin that people just don't want to focus on, because it's too easy to say, well, I own a lot of property. I'm a great example of this, right? I own property, right? It's easy for me to go, I own property, sucks for you. Your problem, figure it out. That is not a good way to care about the next generation that comes along. And that is not why a 28-year-old, like this article suggests, is in fact living at home. That's a wildly disconnected position, and one that I openly do not agree with. But, I understand that people don't always feel that way. Let's talk a little bit about mortgage rates. Okay. I think there's two more articles that I want to share with you guys today about the housing market and rates that I think are impactful and important. This is one of them. The share of U.S. homeowners with high rates on their mortgage has jumped sharply in the last few years. That's having a marketed impact on refinance market and a somewhat more muted impact on home sales. Rates have been front and center in the debate on how home affordability, and for good reason. Of course, this is what we're looking at here. This is the chart that I referenced would be coming. So I always talk about on the show, and you've probably heard me say this many, many, many times, depending on what platforms you listen to me on, that only 60% of the properties in the country have mortgages on them. Yes. And of those 60% of them have mortgage rates below 5%. And this chart shows that. And for those of you who can't see, I'm going to help you out here. 21.9% is at 33% or below, right? So that's, let's just do this over here, 21.9. 29.6 is at 3 to 4%. So 29.6. And then 16.1% is at 4 to 5%. 16.1. So that's 22, 38 plus 29. So 50, 60, over 60%. Yeah. So there you go. That just proves out all the math that I've been talking about for a long time. So that's your mortgage lockout effect, right? It's down here. Is everybody's below those markets. Today's current interest rate for the 30-year is somewhere between, call it 6 and 7%, right? Of that, you got 5.2% of the population who've got a rate 7 to 8%, and you got a 14.7% who've got 6 to 7% current today's market rate. So really, those are the only ones that are hyper incentivized to refinance right now for a rate and term refinance. If you're pulling cash out, it's always a different argument. That ain't a lot of the population. This is 5.2% of people who have mortgages. And again, that's 5.2% of only 60% of the population. So it's even less than it looks like. And that's a pretty interesting factoid when you think about it in the context of a mortgage lockout effect, what that really means for you, me, and everybody else in the housing market. It's a problem. It's a real problem that's not going to get addressed. And this is why I say routinely on shows that I don't know that this gets solved. I think you got to wait for a lot of these people to die, for these mortgages to mature, for people to want to sell, for them to legacy estate plan. Unless there's a catalyst that drives people to sell, and maybe it's rising unemployment, which would be a really shitty catalyst. But it kind of goes without saying that we have to acknowledge the elephant in the room, which, because I've been not working out very much, is also a metaphor for me. So yeah, you got to look at the fact that if AI causes there to be less demand for employees and wages are 58% below affordability. So again, somewhere call it the 2.5% range for mortgage rates. So if we change mortgage rates where they are today to about, call it 3.5% to 4% below where they are today, homes are affordable by pricing again. If we drop home prices about 35% and don't change anything else in today's market, you get homes more affordable again. Or wages go up 58%. Okay. Tell me where the biggest delta is. The biggest delta is in wages, and that is not going to improve in the AI economy. We've heard this from Microsoft CEO. We've heard this from Anthropic CEO. We've already heard comments from people in Congress who are policymakers, and Scott Bessent, who is a policymaker in his own right, who's very much attached to the White House, who have a material and pretty much dismissive disregard for what's actually happening. And they're talking about things that not only are not happening the way they're talking about it, but are so outdated, it's ridiculous by anybody's standards who's actually used AI. So I think there is a disconnect in the market. I think this is really impacting people in a meaningful way. And I don't see a future here where this gets any better. But if Jamie Dimon were here, he would say to you, to me, to everybody else, you got to live with the world you got. So if this is the world we got, you've got to face a harsh reality that you've got to find a way to improve your wage position. And the best way to do that is, unfortunately, the way we preach in the show. You can either improve your wages at work, which you're 9 to 5, or you can find a 5 to 9. And we're going to wrap the show up on this because this is something that if you listen to the show and you've known me for any length of time, personal or not, you know I viscerally believe in this concept. And I'm going to give it to you. Michael, I see on Instagram, he just joined. He's a great example of this, and he's a great example of how successful it can be. But I'm going to show you guys what I think is a really important lesson here from Forbes. And I'm not a big Forbes fan. This article is linked in the show notes, and I believe it is anyway. For today's live, high-end side hustles are surging. How to get in on the action. This is not because people want to work a lot. It's number one, if you have a hobby, great. We're all humans. We need purpose. We need focus. That's important. Number one. Number two, if our wages are not keeping up with inflation, the real inflation cost to you to meet everybody else out there is closer to 20% when you change the weighting of inflation to necessities versus nice to have things. And you look at wage inflation has not kept up with the cost of living, you see something like this where high-end side hustles surging in on the action makes a whole lot of sense. Matter of fact, this podcast started off as a side hustle and has now become kind of a main hustle in some ways. I still make money other places, but I like doing this, and I think this is something it's important to share with people. So when Evan Fisher started his business, Unicorn Capital, as a side hustle, he recalls, I had $10.21 in my bank account and needed to figure out how do I earn money while I was based in a country where I literally could not get a job. Extreme sets of circumstances, but diamonds do get built with pressure, right? So you can go on this article. And I think it's a good thing to listen, to read about. But I'm going to give you some of the highlights that I think are meaningful for you, me, everybody else who have been on the fence about doing this. And I understand corporate employers don't like the idea of you doing things that are conflict of interest. And if you work in a W-2 job, you got to be cognizant of your company's HR policies. That being said, keep in mind this data is also skewed because a lot of people who are worried about losing their primary job don't disclose they do have side hustles, and they do it anonymously, or at least to the extent they can, undercover. Fisher isn't alone in the market. The most of the opportunities to start high-end side hustles, about 36% of people in the U.S. with full-time jobs, about 58 million people in total, have side businesses, according to findings from Emergent Research. You can't find a profession or industry or any type of work where there aren't side giggers involved, said Steve King, principal of the research firm based in Lafayette, California. While 41% of side giggers make $5,000 or less. Perk up here. These numbers are important. 41% of side giggers make $5,000 or less in their businesses. Another 32% make $20,000 or less. Emergent research found that 7 to 8% earn $100,000 or more. They tend to be concentrated in particular niches. Professional services and the creator economy are two of the most lucrative. Okay? I mean, come on. There's a reason why people are doing this. It's not because people want to work 24 hours a day, 7 days a week. It's because they need the money, right? Looking to supplement your income with a high-end side gig? Some of the tips from a panel of entrepreneurs who joined the New York Public Library for a recent event on starting a side hustle that pays real money, where I was as a volunteer moderator. And it goes on to talk about some of the things you can do to kind of hone in on your own talents, or some of the things. I always tell people do something that you're passionate about, but I understand for everybody that could be very different, and it's really hard to tell what that is. But that article is certainly a good kind of perspective point. And I hope the show was a valuable one for you today. As promised, 50 minutes or less. We'll give you the total view of the market. Let's go back and look at some market details. I'm also going to hit up the comments before we call it a wrap. Interesting comment about increasing minimum wage. Let's go to this one here real quick. Interesting comment about increasing minimum wage. One could argue that's what led to the cost and then prices going up too. I would actually argue something different here. I would say yes. Inflation, this does tend to cause inflation, but the disconnect is not when you increase minimum wage over time. It's when you give a sudden boost to it, i.e., stimulus checks. If you look at the inflationary efforts and impacts of the stimulus checks, that was a huge part of that problem. And there is a compelling argument to be made from a fiscal economics perspective that this logic, which was kind of Alexander Hamilton's era of economics, has changed. That GDP is really pushing inflation, not consumer spending, outside of like one-time boosts like stimulus checks. The government offering $2,000 to $4,000 as a refund for tariff earnings is ironically an interest-free loan to the government where they're going to then create that stimulus effect once again. We talked about this on episode 320 of the podcast. So I think traditionally speaking, you'd be right. In an ideal economics model ecosystem, that would be correct. Unfortunately, in real world practical applications, I don't think so. I think the matter of fact is, as you've seen this in California, for example, as you've increased minimum wage at restaurants, they roll out a law that if you have a franchise or multiple locations in a restaurant, that your minimum wage, I think it was like 20 or 25 bucks an hour. It's a significant increase. You have not seen a wild spending inflationary trend from these people because the cost of living has gone up so dramatically. Again, real inflation to you, me, everybody else, about 20% in real world spending would not be offset by increasing minimum wage for the lowest wage earners. As a matter of fact, there's also an additional argument that this K-shaped economy has GDP, which is 70% consumer spending, led by the upper wealthy people who have more discretionary spending there. So let's see what else we got here. I watch dogs. Yeah, that's right. Sean, he does have a doggy daycare. That's right. I forgot about that. The comment at first, I was like, wait, what the hell is he talking about? Yeah, you do watch dogs, brother. But you know what? It's an income and it makes good money and you're growing and scaling that business. So far be it from me to judge in any way, shape, or form. Let's go to the market status, see where we're at today to wrap up the day. We are still, okay, we've seen some small improvement here. We went from a defensive mixed day up to a bit of a tech rally. We're seeing a little bit of a bounce back in the tech sector. That's to be expected. I didn't think a lot of what we saw in the semis to start the day was that bad. Let's go to the sectors real quick and take a look at a couple of these, not all of them. I think I want to see a little bit about what we're seeing in some markets in particular. Let's go to make a cap. That's the one I want to see. Okay, so NVIDIA is still down on the day. Amazon slightly down. Alphabet slightly down. So it's really not the mega caps which are leading in the tech side of things. It's probably going to be, let's take a look at the status again here. Okay, interesting. So we are starting to see a little bit of a build back. Let's see how this plays out over the course of the rest of the day. But thanks for tuning in, everybody. I know it's a lot of dense information in a narrow period of time. I don't have my handy dandy co-host side with me to look sexy and make this a little bit more appealing to you visually. I apologize. But you know, some of us got to earn some money still. That being said, thanks for tuning in. We will catch you on the next one on Friday for a weekly recap. Love and appreciate you guys. Okay, bye.